Did you know that whole life insurance is more popular today than it was 10 years ago? And that's despite all the people who are out there telling you it's too old, it's too outdated, it's too expensive, it's simply not worth it. So what is it that's driving all these people to buy, in more numbers than ever before, this old, outdated, stodgy financial product? Hi, I'm Brandon, founder of the Insurance Pro blog and licensed insurance agent, and I've certainly sold my fair share of whole life insurance throughout my career. And I will tell you there are three basic reasons people tend to buy whole life insurance. They are asset transfer liquidity, end-of-life expenses, and cash value. And we're going to dive into all three of those things today and explain them so that you can understand what it is that has so many people looking at whole life insurance today. Dying is expensive. It's especially expensive if you have assets. When you pass on, people will need to settle your estate, and the process of settling an estate can be expensive. There are a number of costs that are associated with handling an estate, both large and small. And a lot of times, these expenses are not always super intuitive. Life insurance acts as a really great way to quickly access the cash that's necessary to pay for things that are associated with settling somebody's estate. So owning a whole life insurance policy with the intention that it will provide the funds necessary to your heirs to pay for those expenses is a fairly prudent move. I'm not talking necessarily about estates that are super large. We'll get into that in a minute. But for most people, there are going to be charges that your heirs are going to face as they try to take the assets that you own and transfer them to themselves. Sometimes the assets that you hold are illiquid. These are things like real estate or small businesses, and the process of giving them to your kids, your friends, relatives, whomever it may be, is not necessarily as straightforward as you were hoping. There are also expenses that may be incurred to maintain those assets in the interim. And while your heirs are working on the process of settling your estate, there's bound to be a number of expenses they didn't really think about and you didn't really think about that will be incurred. Things like travel, postage, professional fees, insurance costs, especially property insurance costs on real estate. For example, let's say you own real estate as your primary home that you intend to leave to your children. You currently own property insurance on that home, but when you die, that property insurance will terminate with you. It would be prudent for your children to go out and buy property insurance to protect the home while they go through the process of probating the estate to get access to the real estate. But when they go to the insurance company to buy insurance, it's not necessarily going to be a continuation of the property insurance policy you owned while you were alive. Most of the time, this sort of real estate will be uninhabited, which means the risk of bad things happening is considerably higher than when someone is living full-time in the home. Insurance companies are aware of this, and many of them simply won't insure the residents at this point. Or they're going to ask for a significantly higher premium to insure the property. You may also hold assets that are very common that are trickier to move from one place to the next than you might assume. And even if there is large amounts of cash in these assets, you may find, or rather your heirs may find, that they don't have access to them in a way that allows them to cover expenses while the probate process is unfolding. Something as simple as your bank account could be a large sum of money that proves to be a little bit frustrating to your heirs. If you are the sole owner of your bank account, you do not have a transfer on death set up, nor have you named a joint tenant to the account. When you die, your heirs won't necessarily have immediate access to the money inside your bank account. There are steps they'll have to go through in order to gain access to it. And there may be expenses that come due in the meantime that they don't necessarily have the money for. Life insurance skips this whole process because when you die, your beneficiary simply files the claim with the insurance company and gets paid. This is, I assure you, a much simpler, quicker, and easier process to follow than transferring even a simple bank account or getting access to the funds inside somebody's bank account once they're no longer alive. Additionally, life insurance can create the funds necessary to cover tax liabilities on assets that you may not want or your heirs may not want to sell. For example, let's say you have an IRA, a traditional IRA that has income producing assets in it that you bought at a really great yield. It would be your preference and your heirs' preference to continue to hold those shares indefinitely to collect the income that they produce, because selling those shares to pay the taxes that would be due on the transfer is less ideal than sitting back and collecting the income. A perfectly reasonable situation that I have run into a time or 10. Instead of needing to sell the shares to cover the income tax liability that is due for the IRA transfer, you could instead own life insurance that will pay your beneficiaries, who will then take those funds to pay the taxes due while keeping the shares that they inherit from the IRA completely alone and continuing to produce income for them for the rest of their life. Now, the big one that always comes up in this conversation is transfer tax, specifically estate tax, specifically the federal estate tax. If your assets are significant enough to subject you to a estate tax liability, life insurance is one of the most common tools used to deal with that tax bill when it comes due, which is much sooner than most people realize. If the value of your assets on the day that you die is large enough to create a taxable estate, the federal estate tax is due 9 months after the date of your death. If your assets are such that it would be difficult, if not impossible, for your heirs to liquidate even some of them to pay the taxes, they have a problem on their hands. Life insurance has long been one of the most favored tools to create the cash necessary to cover this tax bill within the time frame that it's going to be due without having loads of anxiety over the process of selling the assets that your heirs are ultimately going to receive. That may not be super ideal. They may need to rush the sale and get a lower price than ideal, or they may simply have a hard time getting access to the assets within the 9-month period they have available to pay the taxes. And just because you don't have an estate tax liability today doesn't mean you won't have one on the day that you die. The growth of your assets or changes in tax laws that perhaps reduce the exemptions that are currently available for the estate tax calculation could dramatically change whether or not your estate is taxable at the federal level to transfer the assets to your heirs. It's well worth seeking out the advice of a professional to evaluate what risk you face in this context. Whole life insurance is the one life insurance product that guarantees you cannot outlive it. Provided that you pay the premiums that are asked of you, the death benefit of a whole life policy is guaranteed to last to maturity, which is designed to last longer than you do. This fact, this feature of whole life insurance is something that some people are drawn to, and it actually makes some of them avoid term life insurance because they feel like that's just wasting money because the chances of getting paid a death claim on a term life policy are quite low. I don't really agree with this approach or this view on term life insurance, but nevertheless, the truth is whole life insurance is a product you are guaranteed to have when you die. And because whole life insurance can guarantee a death benefit, regardless of how long you live, it is frequently used as a product that can cover immediate expenses upon death. The most common example, of course, is a funeral. There are many, many people who buy smaller whole life policies and hold on to them with the intention that this is going to cover my funeral and any other sort of minor expenses that will be due very immediately upon death. Sometimes people buy these policies much later in life. They fall under a specific category we call final expense policies, and they generally have different underwriting protocols and slightly different provisions to how the death benefit gets paid depending on how long the individual lives. But a much larger percentage of people buy relatively small whole life policies years in advance and hold on to them for many decades with the intention that that policy will pay for final expenses. Many of these policies achieve paid up status years in advance of death. So the individual owns the policy, they have the death benefit outstanding, but they don't actually have to pay any premiums for it for quite some time leading up to the time they die. Which is a great thing, but I do want to warn you that this can cause some administrative headaches for your family if they don't know much about the policy or policies that you have in force. Because it's often the case that these policies achieve paid up status, there isn't going to be a bill that shows up to tip off your loved ones that there's a life insurance policy outstanding. So it's well advisable that you have some degree of conversation or notes somewhere for your heirs to look at and use to identify what exists for a life insurance policy and where it exists. In other words, what company issued the whole life insurance policy that they can now go file a claim with. I've been involved in a number of situations with individuals who suspected a policy existed. Perhaps somebody mentioned a policy existed, but nobody really knows exactly what it is and what company issued it. So there's a bit of a hunt that goes on trying to locate this insurance policy. And that can be a rather drawn out process. Another pro tip and plead from me, speaking from experience, is to those who have bought multiple policies but didn't necessarily keep all of them. Please purge your records of old policies you no longer own. It is quite a lot of work to call a number of different insurance companies trying to figure out who has the policy that you bought last and who had the policy that you bought some time ago but no longer have. And do understand that the process of buying whole life insurance to cover final expenses is very different from the process of buying life insurance to recover lost wages if you die prematurely. Yes, there are people who are going to cover some of that objective with whole life insurance, but it's rarely going to be the case that you're going to buy enough whole life insurance to completely protect yourself or your family from lost wages if you die prematurely. Term insurance is an excellent product for that purpose, and you shouldn't avoid it just because the chances are that you'll probably live longer than the term policy does. Whole life insurance builds cash value. That is a hallmark feature of whole life policies and a key differentiator between it and term life insurance. The cash value that accumulates in a whole life policy comes from two different sources. One is the payment of the premiums that are necessary for the death benefit of the whole life policy. They do over time produce cash value, and they do grow at a certain guaranteed rate of interest as the policy exists. The second way is through the receiving of dividends used to purchase what we call a paid-up addition to further build cash value within your whole life policy. It's possible to own a whole life policy that only accumulates cash value from the payment of premiums and the accumulation of guaranteed interest. But I assure you that when you have a whole life policy that's doing both, building cash value from premium payments and guaranteed interest, plus the use of dividends, you will have substantially more cash value. Once the cash value of a whole life insurance policy exists, you are free to do with it whatever you wish. And you have access to the cash value in a whole life policy either through a withdrawal or loan against the policy. A number of people are drawn to whole life because of its cash value once they learn how unique it is relative to other lower risk assets. It has proven to be a fantastic substitution to bonds because whole life insurance has far greater liquidity, much better principal protection, and superlative tax efficiency. It's not always intuitive to people, but bonds are a relatively illiquid asset. I realize that bond funds have introduced a certain amount of liquidity to bond investing, but that liquidity is somewhat synthetic and it creates a dilution of returns for people who want to be invested in bonds. Buying bonds directly, which is tricky for a retail investor, definitely highlights the fact that the liquidity of bonds is a far more tricky aspect than most people who are retail investors at least realize. For the most part, if you're going to buy bonds directly, they're best bought with the sole intention of holding for the income that they produce. But if you find yourself in a situation where you need to raise capital and need to sell your bonds, that process is a bit more complicated than most people realize. Whole life insurance cash value doesn't contend with any of that. It's very liquid. You can access it whenever you want to and for whatever reason you wish. There's no limit on how much cash you can access at any time in terms of a minimum amount or maximum amount of cash value that you must take from the policy if you're going to take money out. And because life insurance cash values don't fluctuate downward, there's no worry of a bad economic circumstance making it a bad time to access the cash value in your whole life policy. Because bonds can lose value when interest rates go up, you may own bonds or a bond fund that has been beaten down in price and now may not be a good time to sell. That problem doesn't exist with whole life insurance. And while bonds have largely been thought of as a good asset choice to move in the opposite direction of stocks, empirical data has shown us that bonds are actually very tightly correlated to movement in the stock market. which means when the stock market goes down, bonds often go down as well. This is not at all an ideal circumstance if you're looking to build diversification of possible risk to loss in various economic situations. Whole life insurance, on the other hand, does not move at all with the stock market. And so, if stocks and bonds go down, whole life insurance doesn't. It can't. It's guaranteed not to. So, if economic conditions are deteriorating and you need cash, but you don't want to go to your stock portfolio or your bonds, you don't have to if you own whole life insurance, because you can simply use that as your cash infusion and not worry about the fact that your other assets have lost value and need more time to recover. Additionally, on the subject of bonds, there is a significant amount of complexity that goes into how bonds move relative to changes in interest rates. Much more sophisticated bond investors are well appraised of this aspect, but normal retail investors are fairly clueless on this subject. I would even argue that most investment professionals are relatively inexperienced in all of the applications that must be considered when trying to speculate on what the movement in a bond par value might be given certain interest rate circumstances. And I think we have seen unfold in the past couple of years a substantial amount of evidence to support that idea. Many investment professionals told their clients that if the Fed lowered interest rates, bonds would rise in price. But the Fed lowered interest rates continued to rise, and bonds haven't increased in price at all. Life insurance enjoys an array of tax-friendly attributes. It grows cash tax-deferred, you have access to cash tax-free, and the death benefit paid on a life insurance policy is received income tax-free to your beneficiaries. The deferral of taxes on cash means that you don't stunt the growth of cash accumulation on a whole life policy, as you have to pay taxes year over year after year. And you can access the cash in a whole life insurance policy without income tax liability, either as a withdrawal of your cost basis or taking a loan, because loans are not recognized as income distributed from the whole life policy. And so long as the policy remains in force and does not lose life insurance status, that loan will never create an income tax liability to you. And because you don't have to worry about income tax liability on distributions, you don't have to be careful about the timing of your distributions from a whole life insurance policy. So, for example, if you're getting towards the end of the year and you need money, you don't have to worry about deferring the withdrawal until the following year to try and push the tax liability into a future tax year. You can just take the money out and do with it whatever you want to do, because it's not going to create an additional tax burden to you. You also have the ability to transfer the value of your whole life insurance policy to a new insurance product without incurring a tax liability. There's a special section of the tax code that allows this for insurance products. This means that you can build value in a whole life insurance policy. And then as time goes on and products evolve and new features may become available, you can actually transfer what you created into a new life insurance contract or annuity contract and benefit from the features of that new policy when you take the value you built inside your original whole life policy with you. And you get to keep your tax basis, which has additional benefits to you in terms of minimizing tax liability from the features of the new contract. On top of all of this, you also have the ability to access the cash in your whole life policy and not forfeit the wealth building that is going on in terms of the cash accumulation inside your whole life policy. When you take a loan against a whole life policy, cash doesn't actually leave the contract. It remains put and it continues to grow at the guaranteed interest rate and in general earns some sort of dividend. That means you have access to your cash. You can go buy other things with it, but you're not forfeiting the growth of the value inside the whole life policy. So if you plan on paying the loan back to the whole life policy, you actually have an opportunity to leverage the value built inside the whole life policy, spend some of that money acquiring perhaps some other asset, but continue to build your wealth because the cash will continue to grow inside the whole life policy. And if you pay the loan back, this puts you way further ahead than liquidating an account to buy something else and then trying to replenish the money some other way. This can make the process of acquiring additional assets or making certain major purchases far less expensive than they otherwise could be. Take, for example, purchasing a car. Paying cash is considered a virtuous move to save money so you don't have to pay interest to a financing company. But if you bought your car with a life insurance policy loan with the intention to repay that loan to the insurance contract, you are buying a car that you need to live your life while also continuing to harness the cash that's already inside your whole life policy. And by virtue of repaying the loan, all you're doing is getting yourself to a place where now you have unencumbered the dollars that are growing inside your policy. This will put you much further ahead than if you were to just save the money to buy the car as cash in the bank and then deplete the account to purchase the car and then work on rebuilding it in the meantime. And it puts you ahead because you constantly have this sum of money that is earning the guaranteed interest plus dividends on the whole life cash value. When you use this approach to acquire other income producing assets, there is an even greater wealth building opportunity at your disposal. So while some consider whole life insurance to be old, outdated, expensive, relative to some of the newer creations of financial instruments, the truth of the matter is there's a lot that whole life insurance offers all wrapped up in one neat little package. It offers some incredible guarantees, and it is certainly no slouch when it comes to wealth building capability. And it also pretty easily transitions in between different objectives if need be. So there is an adaptability to whole life insurance. Perhaps you bought it for one reason when you were younger, but decided after a few decades it would be better suited for a different objective. Whole life insurance can certainly accomplish that. And as I already mentioned, you also have the ability to transfer the value that you accumulated in a whole life policy to a new contract more specifically designed for some change in circumstances or just something better that came along. Throughout my years in the industry, I have certainly helped a number of people take an old whole life purchase that they made decades prior and transfer it to something new that's more suited for their objectives moving forward. But had they not bought that old whole life policy years ago, they would have never had the money that they could transfer to this new product and put themselves so far ahead with it. And that can have a significant amount of benefit.